See, it's called liabilities and payroll. And so we'll get down to the second screen here. There we go. Talk about the objectives. We'll talk about what current liabilities are. We'll talk about them in relation to accounts payable, current portion of long-term debt, notes payable. We'll talk about payroll liabilities. We'll talk about payroll accounting systems, and then a few other topics besides that. We'll talk about fringe benefits, vacation pay, and pensions, accounting treatment for contingent liabilities, product warranties, and then talk about the quick ratio. So the first thing we'll talk about is current liabilities. Basically, when a company or bank advances credit, it's making a loan. The company or bank is called a creditor or lender, and then the individual who is borrowing or receiving the funds is either a debtor or a borrower. Okay, so basically a creditor or lender is the bank, a debtor or a borrower is somebody borrowing from the bank or any party who's lending the money. You also have long-term liabilities. Just think 1 year. Anything beyond 1 year is a long-term liability. And a current liability is debts paid within 1 year. Okay, just 1 year or less. Account payable, probably one of the most common current liabilities. It's transactions arriving from buying goods and services from basically other businesses. So you take possession of goods today, or services are delivered to you today, and then you pay for those goods or services sometime in the future. You can see here just some sample businesses and what percent of total current liabilities makes up current liabilities. So for some it's quite a large number, but for many businesses it'll be the largest current liability on the books. Quite often long-term liabilities, of course, are paid back in periodic installments. A company may have a mortgage or bonds or some kind of a long-term note. Quite often a vehicle loan might last several years, and basically obviously as those payments are made, if they're monthly, quarterly, however often they are, whatever is due within 1 year is classified as current. Anything due beyond 1 year would be classified as long-term. So an example of a short-term note payable. It says Nature's Sunshine Company has a 90-day 12% note for $1,000 dated on August 1 of 2011 to Murray Company for a $1,000 overdue account. So maybe they had some kind of an account payable and it wasn't paid on time, so maybe it's turning it into a note payable. And when you see the word note payable, now there's an interest component on top of it. Accounts payable themselves don't have interest, but notes payable do. It says when the note matures, the entry to record the payment of $1,000 is $1,000 plus $30 of interest. And whenever you see interest, I want you to think PIT, P-I-T, which stands for principal times interest times time, P-I-T. Okay, so $1,000 loan, principal times 12%, 0.12 times time. And when we use interest payments, we use 360 as our denominator. So it's 90 days divided by 360. That gives us $30. So we pay the note, we debit the liability account, we debit expense, and we credit cash for $1,030. That's the credit to cash for $1,030. Another example then of a short-term note payable. It says a May 1 Bowden Company is the borrower. They purchased merchandise on account from Coker Company. The creditor $10,000, and it says 210 net 30. So when you see 2/10, just think to yourself 210, and then N30 is net 30. The merchandise cost Coker $7,500. Okay, so those are basically the repayment terms. And so for Bowden, they bought the merchandise, and they basically have a $10,000 payable, and if they pay that within 10 days, they can take 2% off the bill, or the net amount is due within 30 days. So Bowden is the borrower. Okay, so we're debiting inventory and crediting payable. And for Coker, it was a sale, right? I mean, whenever we have a sale, there's two entries. So in the bottom right down here, we're debiting receivable and we're crediting sales. Then we have the cost of goods sold piece of it, where we debit cost of goods sold and credit inventory for the cost, which was $7,500. On May 31, Bowdoin issued a 60-day 12% note for $10,000 to Coker on account. So basically what happened is that first entry happened on May 1st with the 30-day due date. The entries were made. We get down to May 31st, and Bowdoin does not make the payment. And so because Bowdoin's not able to make the payment, they're going to talk to Coker and say, what if we just issue a 60-day note, pay you 12%, and so we'll pay you in 60 days and give you 12% of $10,000. And so, for Coker, they have to wait longer to get their money, but they get to earn some interest revenue on top of that. And so for Bowdoin, they're simply taking that note payable and account payable and turning it into a note payable. So you debit the original liability, account payable, and you create a new liability, note payable. And same thing for Coker, they had an account receivable, and so they're going to credit account receivable to eliminate that and turn it into a note receivable with a debit to note receivable. Okay. Then on July 30, so basically 60 days later, Bowdoin does pay Coker the amount due on the note of May 31st, plus interest of $200. So again, PIT, principal times interest times time, principal of $10,000, interest of 12%, times 60 days over 360. That's how we got the $200. So now the entry for Bowdoin is to make the payment, credit cash for $10,200, debit note payable for $10,000, debit interest expense for $200. Then Coker receives the cash. They debit cash for $10,200. They now have interest revenue of $200, and they credit note receivable for $10,000. Short-term note payable, and another example here. On September 19th, Iceberg Company borrows cash from First National Bank by issuing a $4,000 90-day 15% note to the bank. Okay, so a company's borrowing directly from the bank, $4,000. They'll repay it in 90 days and pay 15%. You can see when that happens, the bank gives them the money, puts it in their account, debit cash for $4, credit note payable for $4, and now we've set up the payable. The liability now exists. Then we go ahead and make the payment in 90 days, December 18th. And so again, 4,000 times 15% interest times 90 over 360. Debit the liability, debit interest expense for $150, credit cash. A discounted note has the following characteristics. A discounted note, it says the interest rate in the note is called the discount rate. The amount of interest on the note is called the discount, is computed by multiplying the discount rate times the face of the note. The debtor, who is the borrower, receives the face amount of the note less the discount, called the proceeds. And the debtor then must repay the face amount of the note on the due date. So a discounted note works a little bit different in that you don't receive the full amount. So if you're going to borrow $20,000, you don't receive $20,000. You receive an amount less than that because of the discount that was applied. And let me put this in viewing mode here. And so it says, so Carey Company issues $20,000 discounted note to Western National Bank. Discount rate's 15%, and that amount of the discount is $750. So the principal of 20 times the 0.15 times 90 over 360 is a discount of $750. So it's a discounted note. And so if you have a problem like that in Cengage, it'll say discounted note. And so you make this entry, debit cash not for 20 but for $19,250. Basically, you're paying a portion of your interest expense just right off the top. So you debit interest expense for $750. You credit note payable for $20. Okay, so basically you're borrowing $20. You receive less cash than $20. The difference is interest expense. Okay, your proceeds are $19,250. Okay. When they pay the note, then they debit note payable, credit cash for 20, and that's it. It's like you pay the interest up front, not at you pay at the beginning, not at the end. Okay, I'm going to escape view mode here and just go back into regular view here. So that was about short-term notes. Now we'll talk about payroll and payroll taxes. Payroll is the amount paid to employees for services they provide during the period. A company's payroll is important for the following reasons. Payroll and related payroll taxes significantly affect net income, right? So obviously when your payroll for many businesses is the largest expense, and of course anytime you hire somebody, you're paying them their salary plus you're paying payroll taxes on top of that. Payroll is subject to a lot of regulation, both federal and state, and good employee morale requires payroll to be paid timely and accurately, right? If you have a mistake in payroll, of course, that will definitely affect morale. So liabilities are rising from payroll. Salary is basically the payment for managerial administrative services. Salary is normally expressed in terms of a month or a year. So basically you have a salaried employee who is making the same amount per month, basically no matter what. Then you have a liability for employee earnings. Wages usually refer to payment for employee manual labor. The rate of wage is normally stated hourly or weekly basis. So salary is kind of just a fixed amount per month or year, whereas a wage is typically an amount per hour. It says here that John McGrath is employed by McDermott Supply at the rate of $34 per hour plus 150 times the normal hourly rate for hours over 40 per week. So as soon as he hits more than 40 per week, he gets time and a half. For the weekend of December 27th, McGrath worked for 42 hours, and so his normal rate's 34. So basically for that week, he worked 40 times 34 for $13.60. 2 other hours at time and a half, which is 51. So 34 times 1.5 is 51 for $102. Total earnings of $1,462. And that would be the gross pay. And of course, we all know after you look at your paycheck, the net amount is much lower than the gross amount, right? Because of all the withholdings and taxes and so on. Okay, so the deductions then is your net pay. So gross pay, net pay, know the difference between those two. And of course, we should all know what a W-4 is at this point in time. When you get a new job, basically you're telling your employer information about you, your address, birth date, your social security number, and then basically kind of what your withholding status is. If you're single, married, but you want to simply have withheld higher at a single rate, how many dependents you have, and so on, all come into play because those things affect your taxable income, and so therefore or basically your tax liability, so therefore they impact how much tax will be withheld from your paycheck. So deductions from earnings, so we know that McGrath has made $1,462 for the week. According to his W-4, he claims with one withholding allowance of $70. So basically the wages used to determine his withholding is $1,392, which is the next slide. So you can see here his wage bracket and basically the percent that we're going to use. And that kind of table just comes right from the IRS. Then we have deductions, the Federal Insurance Contribution Act, the FICA Act. You should see something like that on the paycheck when you look at it. Basically, tax withheld contributes to the following two federal programs: Social Security and then Medicare. So basically, Social Security is basically the government taking money from you, setting it aside, and then when you retire or reach a certain age, you get it back. Same thing with Medicare. Helps pay for health insurance for senior citizens. So those deductions here then, you can see that McGrath's gross salary is $1,462. Basically the Social Security rate is 6%. So you can see the $87.72 for Social Security tax. And then he also has to pay 1.5% Medicare. and so that is $21.93. So basically, just think of it this way: when your employer hires you, they're paying you your salary plus 7.5% in employment taxes plus any benefits. Okay, so basically then, quite often you look at the pay stub of any paycheck that you receive, you have the gross amount, the amount for McGrath at the top for the week, less deductions, and you can see that for McGrath, he's, of course, he's being charged 7.5% for Social Security, 6% Social Security, I should say, 1.5% Medicare. Federal income tax withholding is $263.40. He's setting aside some money for retirement, and then $5 for, he says, United Fund. Just imagine charity. A lot of businesses have United Way or somebody come in and basically offer to do payroll withdrawals to make those payments. So total deductions then $398. His net pay is $1063. So just keep in mind, Social Security and Medicare, basically that the employee pays 7.5% and the employer pays 7.5%. So that was the employee side of it, what we just did. Basically, the employee's gross pay minus taxes, minus retirement, minus a contribution to charity. Could have been a deduction for almost anything. Health care, any kind of electable benefits that the employee has to at least pay something for could come out of that. It's long-term disability, AFLAC, those are options too. Payroll taxes then from the employer side. Employers are subject to the following payroll taxes. Of course, they have to pay their side of the FICA tax. Plus, in addition to that, employers are paying for federal unemployment and state unemployment. And unemployment is only paid by the employer, not by the employee. Okay, so just kind of imagine the business is the collector. Okay, so you've got businesses withholding taxes from employees, plus paying taxes to the government because they've hired people. Okay, and so the employee's paying a share. That's kind of the one side of it here. The business is paying a share, and the government is collecting from both. But the business is kind of that collector when it comes to payroll taxes. So the business collects the employee share, plus pays the business share and remits that to the government. Okay, so let's talk about payroll accounting systems for payroll. Payroll systems should be designed to pay employees, of course, accurately and timely, meet the requirements of federal, state, and local agencies, basically for withholding and reporting, and of course provide enough data to management to make decisions about our payroll. Basically grouping employees by different classifications, grades, departments, gender, age, all kinds of information that you need to make decisions and report to the government. Just being able to slice and dice your data any way that is meaningful to managers and gives you the right data for government reporting. And so a payroll register itself then is a multi-column report that summarizes data for each payroll period. So we've got an example here on the next slide for McDermott Supply, kind of just showing us a slice of it. We have employees here on this first column. And we've got Mr. McGrath is right here in the purplish here. He worked 42 hours this week. You can see what his salary was, his overtime rate, and then his grand total here. So several employees are working here for us. There was grand total then of all these employees. The grand total of payroll for the week was $13,902. And then from that, we have to, of course, withdraw all the deductions. So for each of those same employees, we're withholding based on a percent, 6% for Social Security, 1.5% for Medicare. Their federal income tax deducted depends on their bracket plus their withholding status, how many dependents they have, married, single, and so on, how much the employee wants to set aside for retirement, how much they want to set aside for United Fund, and basically all the deductions, the net pay for each employee, the paycheck number used to pay that employee, and then basically the account's debited. Some of the expense goes to sales salaries, some goes to office salaries. So again, we're at least classifying our employees into two broad categories and capturing salary expense based on those. Of course, then next is to record a journal entry to record the payroll, and I use that payroll ledger for the source of making the entry. So I want to debit two expense accounts, the sales and office salaries for the gross amount of their salaries, and then I credit the various payables for what was withheld. Right, I'm withholding. This is basically the recording employees' earnings. So basically, the employer says we're going to pay our employees the $11,122 plus the $2,780, and then based on the various percentages and the withholdings, we're taking this much out in total from the payroll for the month, and the net pay to our employees, our net paychecks, is $8,327.35. So we're crediting the payable to show that this is what we will owe for the week. So the next side of it then is for the employer to record the employer side of payroll tax. And so we have the employer match for Social Security and Medicare, and then on top of that, the employer has to pay unemployment for SUTA, state unemployment, and then FUTA, which is federal unemployment. State's always higher, and federal is always lower. Okay, and we're basically basing that on a payroll of 2710. And so basically, because this business employed people, we have to pay these taxes. The previous screen, that was just for taxes and withholdings withheld from employees that we're going to remit to somebody else. This next entry after this calculation is basically just the employer saying, because we had payroll of $1,210, we have to now pay the government 6% of that for Social Security, 1.5% for Medicare, and 5.whatever% for state unemployment, and it's 5.4% and 0.8% for federal. So state was 5.4, federal was 0.8. The employee's earnings record, just a detailed payroll record, must be kept for each employee. The record's called the Employee's Earnings Report. And so we've got a couple of slides here for John McGrath that just shows that. It's got John McGrath's contact information. You can see it right there. Phone number, is pay rate per week, the equivalent hourly rate, what his job title is, and then the various weeks of the year, how many hours he worked, his regular versus overtime earnings and total earnings, and so on. Okay, so you can kind of see how that all works out. Okay. And then just the rest of the record, basically all the deductions and withholdings withheld from his paycheck during the year. And then, of course, at the end of the year, which is apt for right now, in that we just had April 15th happen, we have then basically you receive, of course, at the end of the year, employers are required to send these out towards end of January, early February. You get this, and this basically just shows, here's what I made for the year. Here's my my salary with various withholdings and so on. This is what you use to help you file your tax return. So payroll checks, of course, are issued then at the end of each payroll period, and they typically include a detachable statement that shows the details of the net pay. Of course, nowadays, most businesses are doing this electronically. You don't receive a paper paycheck anymore. Typically, the way it works nowadays is the business is transmitting your net pay to your bank account, whatever bank account you want that to go to, and then electronically you can log into a system, and if you want to print this, you can, but otherwise you can just view it online, and you can see basically what your payroll check was. Not many businesses actually issue paper payroll checks anymore. Of course, there needs to be some good controls within a payroll system. It needs to be designed a certain way and have some controls. Inputs into a payroll system are classified as either constants or variables. Constants, data that stays the same from period to period. employee names and their social security numbers, right? Those never change, obviously. Well, I guess somebody's last name can change, for various reasons, but typically the name and social security number stay the same. Variables, basically the number of hours that are worked, and accrued sick leave. Of course, some good controls. It says a check signing machine, if that's used, blank payroll checks and access to the machine should be restricted to prevent theft or misuse. The hiring and firing employees should be properly authorized and approved in writing. You want to make sure you're not paying somebody you shouldn't be, especially when it's done electronically, right? If somebody was let go, you don't want to keep paying them. Changes in pay rate should be properly authorized and approved in writing. There should be a couple of people involved in that step and that process, of course. Probably a supervisor plus somebody in HR. Employees should be observed when arriving for work to verify that they're checking in for work only once and only for themselves. You want to make sure that the employee really does exist, and of course many businesses have ID badges or something that you scan in when you arrive for the day, and you scan out or you check out, you log out. There's various ways to do that. Some businesses say just you log into a system when you come in, you log out of a system when you leave, or you scan in, scan out. Payroll checks should be distributed by somebody other than employee supervisors. Of course, quite often now this is done electronically, and many employers will use a special payroll bank account. You fund that bank account with every payroll, and it just adds a little extra level of control when you do that. Next, let's talk about some other issues involving payroll, fringe benefits, vacations, pensions. So, of course, many employers offer fringe benefits. Earning some vacation pay, typically based on how long you've been with the company, receiving some medical benefits and retirement benefits. So vacation, basically a vacation is a liability for the employer, right? As employees work, they begin to accumulate and accrue the vacation, and the employer then needs to record an entry to show the amount of vacation owed to employees as of a given point in time. So it's a very common year-end adjusting entry that accounting makes, working with the HR department, is to say, what's the total of accrued vacation for our employees. We need to make sure we record that as a liability. So you debit expense, credit the payable. You want to record that expense in the period when the vacation was earned, not when it's actually taken, because you want to match expenses to revenue in the same accounting period. So that employee was working for us, right? And by virtue of working for us, we're assuming they're helping us earn revenue in some way. Maybe not directly selling, but maybe ultimately supporting some function that results in our goods and services being delivered to our customers. It's very safe to assume that. And so as that happens, then it's just safe to say that the employee is earning vacation just due to the passage of time, and so we record that expense in the period that they work to earn it, and we make this entry here. Some employers offer pensions. I used to be the administrator of a company's 401k plan. 401k is a kind of like a pension. Typically, most businesses that pay a true pension are more government type jobs. In South Dakota, if you work for city, state, municipal, school districts, you probably get a pension. You belong to the South Dakota Retirement, and you get a pension of some sort. And so pensions, though, just know that they accrue by time served. So basically, the more you work, the more hours you put in or time you put in, then you begin to accrue the benefit. There's two kinds of benefit plans: defined contribution and defined benefit. We'll talk about each one here. Defined contribution is the company invests contributions on behalf of the employee during the employee's working years. It says normally the employee and employer contribute to the plan, and the employee's pension depends on the total contributions and the investment returns earned on those contributions. So that's more of a kind of the traditional way that's kind of been around a long time. Another way, though, it says Heaven Scent perfume contributes 10% of employee monthly salaries at an employee 401k plan. Assuming $500,000 of salaries, the journal entry is as follows. So with the 401k, typically what's happening is there's a match, and what they're saying here is Heaven Scent is going to do a 10% match. It says they contribute 10% of employee monthly salaries to an employee 401k, and so that money is basically put into every employee's account that received the match. And when we make that contribution, we debit expense, credit cash. And I used to do this on a monthly basis for a company for a few years here. And basically, you get everybody's, I get the payroll register is what I got. And then based on, there was like a 3% match that the company did. And so I recorded that by basically just taking everybody's payroll times 0.03. And then I had to enter that into a system. The Hartford was our 401k plan, so I basically, once I calculated that 3% of everybody's salary, I had to log on and record that on the system, and then that gave me a grand total where I wrote a check and basically had that check mailed to the Hartford to fund the employer contribution. And of course, employees also can contribute also. So a defined benefit plan, the employer is obligated to pay for or fund the employee's future pension benefits. Many companies are replacing their defined benefit plans with contributions. A retired employee receives a specific amount based on her salary history and years of service. Defined benefit pension plan of Hinkle Company requires annual pension cost of $80,000. The annual contributions based on their estimate of Hinkle's future pension liabilities. So in this example, which is not the 401k, basically the employer is saying based on years of service and years until you retire, you're always calculating kind of this moving target of what the future pension cost will be. And then you make a contribution to that every so often. Okay. And so it says here that they're going to pay $60,000 to the pension fund. You debit pension expense, credit the $60,000, and then the difference goes to unfunded pension liability. There's also post-retirement benefits other than pensions. Some employers may pay for dental, eye care, medical, life insurance, tuition assistance, and various things for a certain point of time after you retire. And then finally, just something to look at in terms of contingent liabilities, current liabilities on the balance sheet. You can just see here just examples of current liabilities for Morning Joe Coffee in their balance sheet. And then some contingent liabilities. Basically, think of it this way, some liability that may arise from past transactions. If something that happens in the future, it'll trigger the liability to happen. They can be classified into a couple of categories, or two factors, I should say. Basically, likelihood of occurrence can be classified as probable, reasonably possible, or remote. Measurement is estimable, so you can put a number to it, or not estimable, where you cannot put a number to it. So an example is warranty expense. So again, going back to the previous screen, the definition of a contingent liability. So imagine that a company sells a product that has a warranty with it. And so that's a transaction that's happened in the past, and now we're guaranteeing that if something happens to this product, if it breaks down for a certain period of time, the company that sold it will pay for that. They'll pay to replace it, fix it, whatever. So during June, a company sold a product for $60,000 that includes a 36-month warranty for repairs. The average cost of repairs over the warranty period is 5% of the sales price, and so we have to record a warranty expense now. So again, we're coming back to matching revenues earned to expenses incurred in the same accounting period. And so I know if I sell a product for $60,000 with a warranty, and I know that in the future I may have to pay a warranty or maybe not. I don't know, right? I have no idea for sure what that true warranty expense will be. But based on history, prior experience, knowledge that I have today, I can guess or reasonably estimate that I would expect, on average, when I sell something on a warranty, that I pay 5% of that sales price as a warranty for future repairs and replacements. And so based on that, whenever I sell a product that has a warranty, I'll of course record the revenue also in June, but also record the warranty expense. So I'll debit product warranty expense down here and credit payable. So debit expense, credit payable. So I record the expense now, even though I've not yet incurred a warranty claim yet. And in the future, once we begin to actually incur true warranty claims, I debit the liability and I credit supplies or cash, whatever I use to fix the product and take care of it. Okay, so just the three categories then of contingent liabilities: probable, reasonably possible, or remote. What we do, if a probable liability occurs, then we figure out if we can measure it. If we can measure it, then we do make a journal entry. If we cannot measure it, we at least disclose it as a note in the financial statements, just to say that this is out there. We can't measure it, but just so you know it's there. If it's reasonably possible, again, we just disclose. We put something together in the notes. If it's remote, we do nothing. There's no journal entry, no disclosure. Then finally, we'll talk a little bit about the quick ratio. And the quick ratio is current position analysis. It helps creditors evaluate a company's ability to pay current liabilities with current assets. It's based on working capital, which is the excess of current asset over current liability. It's called your working capital. Be aware of that term. The current ratio, which is determined by dividing current assets by current liabilities. So know what the current ratio is: current asset divided by current liability. Then also know that the quick ratio is an indicator of a company's short-term liquidity. How much cash do we have, or how many assets do we have that are easily turned into cash? And so the formula for the quick ratio is just simply quick assets. And quick assets typically are cash and any other current asset that can easily be turned into cash divided by current liabilities. So quick assets divided by current liabilities is my quick ratio. And that is Chapter 10.